Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Stephen Innes, Chief Global Market Strategist at Axi. Steve, great to have you on the show.
Thanks for having me on today, Brian.
Now, Steve, before I speak to you, let's take a quick look at how markets are performing across the region. And it's a sea of green. The Nikkei is up 0.77% to 28,307.68. The Shanghai Composite is up 0.55% at 3,524.42. The Hang Seng is up 1.82% at 29,419.35. The ASX 200 is up 1.44% at 6,758.7. Kospi is up 0.92% at 3,084.72. Even closer to home, we've got Bursa Malaysia up 0.78% at 1,578.69. Rounding off, we've got the SGX, which is up 0.54% at 2,911.97. Steve, what do you make of regional markets taking their cue from the US and Europe, perhaps?
Yeah, I think it's pretty much the case of all boats are floating on stimulus impulses again. But we also have to think that we've had a bit of a recovery on that systematic risk meltdown we had last week, which there's a buying back in after that, after the risk breakdown on a risk parity breakdown because of the so-called Red Raiders that had attacked poor old hedge funds on the short positions. So we're recovering back to that.
I don't know if people say poor old hedge funds, Steve. I don't think a lot of people would agree with that.
Yeah, well, no, it's like, I mean, there was a couple that were short significant amounts of weak-handed stocks, and they get punished badly to the tune of $1 billion, and that's quite significant in any book. So when you have to really recover from those losses, and you're selling off a large quantity of heavily owned stocks in the market, it's going to have a negative effect. Objectively here, I don't think we've seen the end of it. I think this could be the tip of the iceberg. There's a lot of people trading on these electronic platforms, and I'm not sure how much B-book position, in other words, how much of open risk is on a lot of these platforms on some of these underlying positions that may be dependent on these stocks actually coming back in price. So it'd be very interesting to see what the fallout's going to be going forward. So I don't think we're out of the woods just yet, and I think it's a cautionary tale that we're all going to be remembering as the power of social media and the influence of retail traders. It's just phenomenal what happened last week.
And also, Steve, there's a couple of points I read that I think I didn't realize until recently. One was the fact that a lot of these people are actually these new investors into the market are actually trading their stimulus checks. So that was an interesting insight that came out. So they've never traded before. They had this extra money and they're trading their stimulus checks.
Yeah, they're also trading a little bit of daddy's account and some of their pizza delivery pocket money at the same time. Some of these guys turned huge dollars, huge profits, turning $4,000 accounts into six figures. It was phenomenal how much wealth redistribution happened in the span of 24 hours. But will that fad last? That's the question. I don't think so. I think these are very much fad trades. A system, global market making systems will adapt to these risk meltdowns eventually. Market makers will be very reluctant to price these OTM styled, low held option risks with any great degree of comfort. So in other words, the spreads will be quite wide, and that's just going to sort of die things down a little bit. We saw them go after silver yesterday, but that was a weird trade because the market's long silver, so it didn't make much sense. Sure, there is a shortage of silver out there, but it's really the producers that always hedge silver. They're always short because they produce this stuff. So, I mean, I think they went after the wrong stuff. The producers have lots of stuff in the ground that they can just put back in the market again. So it was sort of a failed attempt, and I think they saw through that, and they'll probably be looking for another asset to go after soon, but I don't think it's going to have the same impact as the trade is proverbially out of the bag right now. So I think the next wave will be less.
Steve, both of us are old enough to remember March 27th, 1980, when the Hunt brothers basically got caught with their pants down with this, trying to corner the silver market. So do you think there's any sort of likelihood that we're going to have a spectacular runoff like that and then a pullback?
No, I don't think so. I think the market makers are too collusive, and knowing it's going to happen, they'll be even more defensive on the strategies. I think what could happen at the retail and institutional level, we've also seen the CME take proactive measures, is that they've increased their margin requirements. That's generally the first step. So, you're getting smaller volumes coming through the market, therefore less of a bigger footprint. So as the trade size gets smaller, the spreads go out. That sort of deflates possibilities of trading. Now, I said this would happen when it first happened on the GameStop. I said this is the number one reaction that market makers will do, and it's already happening. The reason for that is I've been a market maker for 25 plus years, and that's what I do. As soon as I get toxic risk coming in, I widen the spreads and I make the trade pretty expensive to get on. That's not illegal, because in your written agreements with your contract agreements, you're forbidden. You're telling retail traders not to use toxic trades. Ganging up on one market is considered a toxic trade on anybody's book. That's toxicity, and you can actually do whatever you want to thwart that kind of stuff.
Now, Steve, there's also talk now with the new Biden administration that probably markets are going to see a lot more regulation. What's your view on this?
Well, yeah, I mean, does it need more regulation? No, I hate regulation, to be honest with you, but I think this is the new world we're in right now. I think the novelty act of social media is still has its power, and I think it is proven that it could be pretty disruptive. And it's not just the sense here that, to stop retail people from making money, but it's the knock-on effects. Is a disruption in other people's portfolio is really worth it? Look, that really knocked a lot of people's, just average Joe's wealth down, who've been, just as hard saving money out there as everybody else. Because I don't think when these traders went into this trade, they realized how much systemic risk they would have. They probably thought it'd be a small novelty going against one, hedge fund that had the position. But what it ended up doing was creating a lot of negative impulses for a lot of other investors. I don't think that was their initial intention.
Now, moving on to Australia, about an hour plus ago, the Reserve Bank left rates unchanged and actually were pretty bullish on the economy. They're predicting that it would grow 3.5% in 2021 and 2022. Now, where is this optimism coming from, Steve? The numbers look great, but this economy is basically has its borders closed. It has a dispute with China, its biggest customer. The closure of its borders impacts both its biggest industries, tourism and education.
Yeah, I think it.
Where's this?
I just think it's based on the global synchronized global growth that we're going to have over the summer, where everything's going to lift off simultaneously in January. And obviously a lot of supply chains will open up. There'll be a reflationary bounce. But my worry is what happens next. That's the problem. Is that really, it's not really, is that the new normal? Is that the new abnormal? So in other words, are we just going to have 2 months of like super inflationary growth, and then we fall back to the pre-COVID environment where we were actually in a deflationary world? So, I mean, I'm very, very curious to see how this is all going to play out over the long run. Unfortunately, my crystal ball these days gets clouded after 2 weeks. And I think that's one thing we have to really remember right now. When you get to the lofty levels in the markets, what is it going to take to get the markets to the next level? It's going to take better improving economic data. We're not there yet. That's the problem. So the data is going to have to catch up to the price action, not to mention the data expectations priced into the second half of the year are colossally high. So, there's a lot of possibilities here that, things could go incredibly sideways. Look, I'm still very optimistic. Okay. I'm just sort of presenting a case here that there could be problems down the road. We haven't even got into the Biden tax policies yet. That's another issue that we're going to be addressing as we move through 2021, probably towards the latter part, mind you, but it's still stuff that we're going to have to be addressing at some point.
Steve, always a pleasure having you on the show.
Thanks for having me, Brian. Have a great day.
Now, we've been speaking to Stephen Innes, Chief Global Market Strategist at Axis, on the ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversations.